What if I told you that some of the wealthiest people in America, and I mean people worth hundreds of millions of dollars, legally paid zero in federal income taxes for years? Not because they cheated, not because they hid money in some offshore account in the Cayman Islands, but because they understood something that your financial advisor, your accountant, and your HR department never sat you down and explained. And today, right here on Senior Pulse US, I'm going to break it down for you in plain English. No jargon, no fluff. Just the raw truth about a strategy so powerful, so effective, that the ultra-wealthy have been quietly using it for decades, while the rest of us kept writing checks to the IRS every single April. Stay with me, because by the end of this video, you're going to look at your money and your retirement completely differently. All right, let's get into it. It's called the buy, borrow, die strategy. And before you roll your eyes and think this is some internet gimmick or a loophole that got closed years ago, it hasn't. It is completely legal. It's written right into the structure of the American tax code, and it's been hiding in plain sight for a very long time. Here's the core idea. When you earn a paycheck, the IRS taxes that money. When you sell a stock or a piece of real estate for a profit, the IRS taxes those gains too. But here's the thing. The IRS cannot tax a loan. When you borrow money, that is not income. You didn't earn it. You owe it back. So the government gets nothing. Now here's where it gets interesting. Imagine you own $2 million worth of stock. That stock has grown significantly over the years. If you sell it, you're going to owe capital gains taxes, maybe 20%, maybe more depending on your situation. That could be $400,000 or more going straight to the government. But what if you didn't sell? What if instead you walked into a bank and used that $2 million in stock as collateral and borrowed $500,000 against it? You now have $500,000 in cash, tax-free. Because it's a loan. You use that money to pay your bills, fund your lifestyle, travel, help your grandkids, renovate the house, whatever you want. And your original investment? Still sitting there. Still growing. You never triggered the taxable event. You never sold. You just borrowed. This is exactly what people like Elon Musk, Jeff Bezos, and Larry Ellison have done on a massive scale. In fact, ProPublica obtained IRS records showing that several billionaires paid little to nothing in federal income taxes during certain years. Not because the system was broken, but because they understood how the system actually works. Now here's the second part of this strategy, and this is where it really clicks. The die part sounds morbid, but hear me out. When you pass away, your heirs inherit your assets at what's called a stepped-up basis. This means the IRS essentially resets the cost basis of your investments to whatever they're worth on the day you die. So if your stock was worth $2 million when you bought it years ago for $200,000, that $1.8 million in gains? Gone. Wiped clean. Your heirs don't owe a single penny in capital gains tax on that growth. And here's the kicker. The loans you took out against those assets? Those get paid off by the estate. The bank gets repaid. The IRS gets nothing on the gains. And your family inherits the remaining wealth, with a fresh start on their tax basis. That is the complete loop. Buy appreciating assets. Borrow against them instead of selling. Live off the loan. Die with the assets still intact. The loans get paid off. The gains disappear. The wealth transfers. Now I know what some of you are thinking. This is for billionaires. This doesn't apply to me. And I hear you. But here's what I want you to understand. This strategy scales down. You don't need to be worth $1 billion to apply the core principles. Do you have a 401k or an IRA that's grown significantly? Did you know that many brokerage accounts will allow you to borrow against your portfolio through what's called a margin loan or a securities-backed line of credit? Some people use home equity the same way, borrowing against an appreciating asset rather than selling it. The wealthy didn't invent different money rules. They just learned the rules that already existed and used them intentionally. Now let's talk about what the IRS actually does about this. because this is the suspenseful part of the story. The IRS knows this happens. Congress has had conversations about it. There have been proposals, including during recent administrations, to tax unrealized gains, meaning they want to tax you on the growth of your investments even before you sell them. That proposal would essentially close this strategy for large holders. It has not passed, but it's been discussed, which means the window, while open today, may not stay open forever. This is why Senior Pulse US exists, to make sure you're not the last person to know about strategies that could protect your retirement, your savings, and your legacy. Because by the time it's on the evening news, it's usually too late. There's also something called the wash sale rule, the alternative minimum tax, and other guardrails that the IRS has built in to limit certain tax maneuvers. If you start using securities-backed loans aggressively, there are things you need to watch out for. Margin calls are real. If your asset value drops sharply, the bank can demand repayment fast, and that can force a sale at the worst possible time. This strategy works best with stable, consistently appreciating assets, not volatile ones. And one more thing, interest on these loans. It's not free money. You are paying interest to the bank. The idea is that the asset you're holding grows at a rate that outpaces the interest you're paying. Over decades, in well-performing markets, that math has worked out beautifully for those who've played it right. But it's not without risk, and I want to be honest with you about that. This is why working with a financial planner or a tax attorney who actually understands this strategy, not just a basic tax preparer, is so important. You deserve advice that goes beyond contribute to your 401k and call it a day. The bottom line is this: the American tax code is not written to be fair. It is written to be followed. And the people who thrive financially are the ones who follow it. All of it, including the parts that favor asset holders over wage earners. That's not cynical. That's just reality. And the first step to changing your financial future is understanding the rules of the game you're already playing. Before I let you go, if this opened your eyes even a little bit, share this video with someone who needs to hear it. A friend who's grinding away at a job, paying taxes every 2 weeks, and wondering why it never seems to be enough. Send it to your adult kids, your sibling, your neighbor. And if you're watching this and you're already retired or getting close, this strategy has applications for estate planning that could protect everything you've worked a lifetime to build. Here at Senior Pulse US, we are committed to bringing you the real conversations about money, retirement, and financial freedom that nobody else is having. Hit that subscribe button right now, because we've got more videos coming that are going to challenge everything you thought you knew about building and keeping wealth in America. The IRS didn't write these rules to hurt you, but they sure didn't write them to help you either. It's time you started using every legal tool available to you. We'll see you in the next one.